Hello, brothers and sisters, and welcome back to Boss Economic World. Your favorite capitalist road tripper, here to cut through the noise and give you the real story behind the numbers. Today, we're taking a trip to the old continent, to the heart of the Eurozone. And let me tell you, things over there are interesting. The headlines are all singing a pretty song. You've probably seen them. Euro area inflation eases. It's like hearing your doctor say, good news. Your fever is down from a life-threatening 40 degrees Celsius to a merely worrying 39.5. So, let's put on our X-ray glasses, peel back the onion, and figure out what's really happening. The official story, released today, November 1st, 2025, is that consumer prices in the Eurozone rose 2.1% in October. That's a tiny little dip from 2.2% in September. Everyone breathes a sigh of relief, right? The European Central Bank, the big mama of money in Europe, can pat itself on the back. Inflation is almost back to its sacred 2% target. Problem solved, time to pop the champagne? Not so fast, my friends. Not so fast. If you believe that, I've got a bridge in Brooklyn, and a slightly used Eiffel Tower, to sell you. Because the headline number, that 2.1%, is a beautiful lie. It's the Instagram filter of economic data. The real picture, the one without the flattering angles and perfect lighting, is much messier. This isn't the end of Europe's inflation story. This is the beginning of a new, more stubborn, and far more frustrating chapter. I call it zombie inflation. You can't kill it. You shoot it in the head with interest rate hikes, and it just keeps shambling forward, groaning for more. So, what is this zombie I'm talking about? To understand it, we have to look past that pretty 2.1% headline number and dig into the greasy, grimy engine room of the economy. Economists have a name for this: core inflation. Think of it this way. Headline inflation is like your total monthly spending. It includes everything, including the stuff that goes wild. One month, a geopolitical crisis makes gas prices skyrocket. The next, a good harvest makes your grocery bill cheaper. These things are volatile, they're noisy. They're like the hyperactive kids at a birthday party, running around, screaming, and then suddenly crashing from a sugar high. That's your energy and food prices. Core inflation, on the other hand, is the stuff that doesn't bounce around. It's your rent, your internet bill, the cost of a haircut, the price of your gym membership. These prices are sticky. They don't go up and down with the morning news. They go up, and then they tend to stay up. This is the real, underlying pulse of inflation. And what did the data from this morning tell us about that pulse? While headline inflation dipped to 2.1%, the core inflation measure unexpectedly held firm at 2.4%. It refused to budge. It's standing there, arms crossed, staring down the ECB. But wait, it gets even better. Let's zoom in further. The stickiest of the sticky, the component that gives central bankers nightmares, services inflation. This is the price of things people do for you. Think restaurant meals, hotel stays, plumbing repairs, your lawyer's hourly rate. And in October? Services inflation didn't just hold firm, it quickened to 3.4%. Do you see the picture now? The ECB is out there, taking a victory lap because the price of oil had a good month, while the fundamental cost of living in Europe is not only high, but it's still climbing. This, my friends, is the zombie. The headline number looks like it's dying, but the core of the problem is undead and angrier than ever. Why are services so expensive? One word: wages. For the past 2 years, European workers, after getting squeezed by the initial inflation shock, have been demanding and getting higher pay. In Germany, the powerhouse of Europe, the mighty IG Metall Union secured a 4.5% wage increase for 2025. In Spain, public sector salaries were indexed to rise with inflation. This isn't a bad thing for workers. People need to afford life. But from a central banker's perspective, it's terrifying. Higher wages mean people have more money to spend, especially on services. But it also means the cost for the business providing that service goes up. So, your favorite local cafe has to pay its baristas more, and guess what happens to the price of your cappuccino? This creates a dangerous loop, a wage price spiral, where higher wages lead to higher prices, which lead to demands for even higher wages. This is why Jörg Kramer, the chief economist at Commerzbank, hit the nail on the head. He said, at first glance, the inflation problem in the Eurozone appears to be solved. But the persistent underlying inflation argues against the ECB further lowering its key interest rates. He's not buying the headline hype, and neither should you. So, what is the European Central Bank, the guardian of the euro, doing about this zombie? Well, yesterday, President Christine Lagarde and her crew held a meeting. They looked at all this data, and they made a momentous decision to do absolutely nothing. They kept interest rates steady at 2% for the third meeting in a row. Then, Lagarde stepped up to the microphone and, with the calm confidence of a yoga instructor, told the world, from a monetary policy point of view, we are in a good place. A good place? Madame Lagarde, with all due respect, a good place is a sun-drenched beach with a cocktail in hand. A good place is watching your stock portfolio hit a new all-time high. Where you are is on a unicycle, on a tightrope, stretched over a pool of piranhas, while juggling flaming chainsaws. We are in a good place is central bankers speak for. We are utterly terrified of making a move in either direction, so we're going to stand perfectly still and pray the tightrope doesn't snap. Let's decode this. The ECB is trapped. Option 1, hike interest rates further. This is the classic textbook move to fight inflation. Make borrowing more expensive, cool down the economy, and bring those pesky service prices back in line. The problem? The Eurozone economy is already fragile. We'll get to that in a minute, but raising rates now could be the final push that sends it tumbling into a nasty recession. You kill the inflation zombie, but you also kill the patient. Option 2, cut interest rates. The markets are whispering about this. They see the slightly weaker headline inflation and the stagnating economy and think, hey, maybe it's time for some relief. But if the ECB cuts rates now, with services inflation at 3.4% and wages still rising, it would be like pouring gasoline on a fire. You'd signal to everyone that the fight is over. Core inflation would explode, and the zombie would turn into a sprinting, rage-fueled monster from 28 days later. So, they are stuck. They can't hike, they can't cut. Their only choice is to hold and hope. Hope that the 2% rate is restrictive enough to slowly, gently, suffocate inflation without suffocating the economy. It's a strategy straight from the playbook of, don't just do something, stand there. This is the great challenge of the last mile of fighting inflation. Getting inflation down from 10% to 3% is the easy part. It's a blunt force operation. But getting it from 3% to 2%? That requires surgical precision, and the ECB is trying to perform surgery with a sledgehammer. Now, let's add another layer of beautiful European complexity. The Eurozone isn't one country, it's a 20-member club of wildly different economies, all forced to wear the same monetary policy suit. And right now, that suit is fitting very, very badly. It's like a tailor trying to make one suit for a 7-foot basketball player and a 5-foot jockey. Look at the national inflation reports from this week. It's a total mess. Germany, the traditional engine of Europe. Their inflation is easing, but less than anyone expected. Industrial production is weak, but wage pressures are strong. Germany is the stern, inflation-hating patriarch of the family, constantly worried that the ECB is being too soft. They see 3.4% services inflation and they get hives. They want higher rates yesterday. Spain, the sun-kissed economy is running hot. Price pressures are actually building again. Their economy is more service-dependent, tourism is booming, and the labor market is tight. Spain is the cousin who's having a great time at the party and doesn't want anyone to turn the music down. They can handle 2% rates, no problem. France, the surprise performer. The French economy is showing surprising resilience, growing nicely even with political drama. But their inflation is well below the Eurozone average. They are the chic, non-plus sibling who is secretly worried that the ECB's tight policy will kill their buzz. Italy, and then there's Italy. The perpetual worry. Their economy is stagnating, narrowly avoiding a recession, and like France, their inflation is also well below target. They are desperately hoping for rate cuts to help manage their enormous public debt and kickstart growth. For Italy, 2% interest rates feel punishingly high. You see the dilemma? The ECB has one interest rate. It's too low for Germany and Spain, and too high for France and Italy. It's a policy of one size fits none. This isn't a new problem, but it's brutally exposed in moments of crisis like this. Every time Lagarde makes a decision, she's making someone in the family angry. Her good place is actually a very lonely, very difficult place. And just when you think it can't get more complicated, let's throw in some international drama. The data showed the euro area economy grew by 0.2% in the third quarter. That's not exactly a boom, but it's better than the 0% or negative numbers analysts predicted. It's like your mechanic telling you your car needs a $5,000 engine rebuild, and the final bill is only $4,500. You're relieved, but your car is still broken. What's driving this resilience? Mainly France, as we mentioned. But the economy is holding up despite the trade disruptions unleashed by, you guessed it, the lingering ghost of Donald Trump's America First policies. The tariffs and trade wars of the last decade haven't gone away, they've just become part of the background noise. And they are creating a bizarre, two-way pressure on Europe. On one hand, US tariffs on goods from, say, China, mean those Chinese companies need to sell their stuff somewhere else. Where do they go? Europe. A flood of cheaper, diverted goods puts downward pressure on prices. The ECB's contacts with manufacturing companies confirmed this. Some are seeing prices fall because Europe is becoming a dumping ground for goods locked out of the US. This is deflationary. But on the other hand, the general messiness of tariffs, sanctions, and rerouting global trade creates supply chain snarls. It costs more to ship things. It takes longer to get parts. This is the exact kind of supply-side shock that drives prices up. This is inflationary. So, the ECB is being pulled in two directions at once by the legacy of American protectionism. It's another variable in an already impossible equation. So let's bring it all home. What does this all mean for you, whether you're a professional fund manager in Frankfurt or just someone trying to plan a European vacation for 2026? 1. Don't believe the headline hype, the battle against inflation is not over. The easy wins are done. We are now in a war of attrition against sticky, wage-driven services inflation. That 2.1% number is a distraction. The real numbers to watch are core CPI and services CPI. 2. The ECB is paralyzed. Lagarde's good place is a holding pattern. They will not cut rates anytime soon. To do so would be to admit defeat. They will hold rates at 2% through the winter and well into 2026, praying that it's enough. This means borrowing costs in Europe will stay elevated, putting a constant, dull pressure on the economy. 3. Expect a grind-down economy, not a crash. The 0.2% growth shows the Eurozone isn't falling off a cliff. But it's not soaring, either. It's a grinding, sluggish economy, with some parts sputtering while others keep the engine from stalling completely. This is the scenario of stagnation, not a deep recession. 4. The December meeting is the real show. The ECB has promised fresh forecasts in December, which for the first time will look all the way out to 2028. This will be the main event. The ECB currently expects inflation to dip below 2% next year, but then re-accelerate to near their goal in 2027. If their December forecast still shows that re-acceleration, it's a clear signal, no rate cuts are on the horizon. If they suddenly forecast inflation staying below 2% for years, that might open the door for a discussion. What am I, boss, watching? I'm watching the Q4 2025 and Q1 2026 wage negotiation data. That will tell us if the wage price spiral is accelerating or cooling. I'm watching the monthly services PMI reports for any sign of a crack in service sector strength. And I'm watching the political cohesion in Europe. The pressure of this one-size-fits-none policy will test the Eurozone's unity, again. The truth is, the Eurozone has a zombie on its hands. It's slow, it's ugly, and it refuses to die. The ECB strategy is to hope it just starves to death on its own. It's a risky bet. And for the 340 million people living in the Eurozone, it means a prolonged period of high costs, high borrowing rates, and an economy that's just shuffling along, going nowhere fast. That's the full picture, my friends. Not as pretty as the headlines, but a whole lot closer to the truth. Remember to think critically, look behind the numbers, and stay ahead of the curve. This is Boss Economic World, signing off.